Good afternoon, everyone. It is July 8th of 2022. My name is Robert Rayburn here at Life Pro Asset Management. I hope that everyone had a great, fantastic, and fun long weekend and was able to celebrate July 4th with friends and family. Now, over the last week, what we've seen is a continuation of the similar price action that we've all experienced here over the last, really over the last 8 weeks since mid to late May, which is this market treading water, sometimes making new lows, but underneath the surface, the allocation of returns beginning to shift from one area of the market to the other. And in particular, what we mean by that is from value over to growth. That's going to be a key theme, we believe, based on our work over the next 6 months into the end of the year. And why is that? We believe, based on our work, we are going from an inflationary environment to one that is characterized by disinflation. And we've seen that here over the last few weeks through the collapse of commodity prices. So let's go ahead and get started. The title of this week's presentation is that Return of Goldilocks, with a question mark, because we don't know for sure, right? But what we really mean by that is, what happens if the economy inflation is slow without triggering inflation? The consensus view right now is that we're going to get an inflation. But we saw those employment numbers today. They were pretty damn strong, right? Over 300,000 non-farm payrolls, far above expectations. At the same time, we're seeing those ISM manufacturing numbers slow down. We're seeing those new order numbers slow down. We're seeing commodity prices drop, inflation expectations drop. So all of these things beg the question, what if we get a slowdown, we meet the Fed's objectives, and we don't trigger an inflation? I think we're starting to see the price action sniff that out a little bit. So we're going to go through this week, how fast is the economy slowing, and does it portend a deep recession, or does it portend perhaps a soft landing? What are the implications for commodities and inflation? And of course, what works and doesn't work in such an environment? Now, we've seen the impact of interest rates here over the last couple of months. If we look at Target or Walmart, we've talked about this many times, but that glut of inventories in the Wall Street Journal this week on July 4th, we saw a great quote here. What's unusual is the large retailers may not ever touch the products. In other words, they've over-ordered this stuff and they're immediately going to clearance. They are asking us to get in front of this earlier than in the past. There is an unusual amount of excess inventory that's affecting so many retailers at the same time. That is from JD Daunt, Chief Commercial Officer of Liquidity Services, that focuses on inventory management. And we saw him here in real estate. Home sellers are slashing prices in a sudden halt to the pandemic real estate boom. Activity has slowed down dramatically. This is what the Fed wants. They want these inflationary assets to be slowing down. They want price control, and not price controls by the government, but a control in those price increases that we've seen across the economy. This is a healthy symptom. Now, we talked about that ISM manufacturing new orders number. We see here, ISM manufacturing new orders is sharply slowing. And that is a good and healthy thing if you are an investor in the stock market. At the same time, we see here the non-farm payroll number that came out today. That's that monthly employment number that is so important. 372,000 new jobs created versus 390,000 last month. So a slight slowdown, but nowhere near recession. Typically, when you get a recession, these numbers actually go negative for a few months ahead of a recession. We're not even seeing anything like that right now. That unemployment number steady right around 3.6%, and average hourly earnings stay in control at that 0.3% month over month growth number. That's a good thing. People are making a little bit more money, but not too much money to trigger an inflation wage price spiral. That's what we want to see. The other thing, we're seeing a little bit of relief at the pump here. Not only have oil prices come down dramatically, I think it was back on Tuesday, oil went down 10% in one single day. We're seeing that commodity sell-off across copper, wheat, corn, cotton, you name natural gas is in a downright vicious bear market, down 40% off its peak or so. We're seeing these prices come off dramatically all across the board, and we're starting to see that gasoline prices in terms of gas at the pump. All of this is a very, very good thing. So the question is, lower oil, does that lead to lower headline inflation? And does lower headline inflation lead to lower rates? And if we're getting lower rates, what does that mean for asset allocation in terms of value stocks versus growth stocks? All these are very, very important questions. Now, let's look at those expectations. What is the market pricing in the swaps market? So when we look at the swaps market, so in other words, what's the bond market telling us about future inflation expectations? 5-year inflation expectations are dropping off dramatically. They really peaked back in April or late March and have just dramatically dropped off since then. And in fact, we look at the monthly inflation expectations annualized going ahead over the next year, we're seeing a big drop off here over the next 6 months. But just as important, those month over month inflation expectation numbers have dropped between July 7th and June 16th of last month. So June 16th is that gray number right here. You can see this was the projected forward inflation expectations month over month. This is now the same time period going forward, but as of July 7th. So we're seeing this big drop off in inflation expectations. Why is that? Look at commodity prices, look at the jobless claims number, look at the month over month wage growth numbers. They're all moderating significantly. And of course, those inventory numbers at the retail level. We believe that we are entering into a disinflation cycle, and that is what we thought was going to happen in January. It was delayed by the war in the Ukraine. Now that that war in the Ukraine is starting to become less intense, we think a lot of these factors are starting to finally play out, and that bodes well, we believe, for growth stocks versus value stocks. We think the portfolios are well positioned for that move. And we can see what this means in terms of interest rates. We looked at those dropping oil prices. We looked at the drop in inflation expectations. What does that mean for interest rates? Let's look at the expected Fed funds rate over the coming 2 years or so. And what we see is future rate expectations back on June 15th were expected to continue going up all the way until really mid 2023. Look at how much flatter it's become now. So remember what we said a few weeks ago was that when you buy stocks, you're really buying a futures contract on what you think interest rates are going to do beginning in January of 2023. We can see that now, that overall slope is starting to flatten out. In other words, the market believes that rates are going to go up less fast than they did a month ago, and that rates are actually going to start dropping sometime in 2023. In other words, buy assets that have a huge amount of growth well off into the future versus a lot of growth here in the present. So why do we do that? How do we position for a world like that? We want to buy growth in a growth-starved world. We used this slide last week, and we're going to use it again. Why? Because it's relevant, and we believe it's going to remain relevant over the next 6 months and beyond. When growth slows, when inflation slows, fewer and fewer companies are able to grow as the U.S. economy slows down. In other words, those companies that can grow, investors are willing to pay a higher multiple for those companies that can effectively grow in a low growth world because there's not that many of them. So you get what's called multiple expansion. The PE, or the price to earnings ratio, the price to sales ratio, begins to expand because there's a lot of investors chasing a select group of stocks. The 3 areas in particular that we really like right now, the China recovery story, so a lot of China domestic stocks, biotech and healthcare, and number 3, cloud computing. If we look at the biotech chart right now, what we see here, this is biotech stocks relative to the S&P 500, made a bottom in around mid-May and has broken out to higher highs despite a market that's sitting near lows. This group is trading at its first 3-month relative high in over 2 years. And this is one of the areas that has, in our opinion, based on the research that we look at, some of the best prospects in terms of innovation and future growth over the next decade. Then we look at Chinese stocks. So if we think of Chinese stocks, just in general, some of your household names such as Alibaba or JD or Tencent or Pinduoduo or Weibo, these types of names, we can see they actually made a relative strength low back all the way back in March and have made relative strength highs or relative highs ever since then, higher lows and higher highs. We've seen them tail off a little bit as of the last week or so. Again, letting off a little bit of steam since this big rally through March and into April and June and July. But we think that this is going to be one of the leading groups here over the next 6 to 12 months, and also one of the cheapest out there. Lastly, software is beginning to fight back. In particular, we love cloud computing stocks. We love the recurring revenue model that a lot of these companies enjoy, especially when you're going into a low growth environment. When you can secure those recurring revenues, doesn't matter if GDP is at 1% or 5%, your stock's going to receive a pretty decent premium during those low growth periods. But listen, software was at the center of the growth storm, but since May has started again against what has been a lower low for the overall S&P 500, has started to make higher lows and higher highs. And this is on a relative strength basis. So this chart again is software stocks relative to the S&P 500. So bottom line, ladies and gentlemen, I know this is a bit of a shorter presentation than usual, but it's been a shortened week because of July 4th. The economic growth engine continues to slow, but overall, that employment data is suggestive of a possible soft landing. So we think concerns over growth are beginning to outweigh those inflation concerns, and that plays right into our bailiwick as growth investors. Number two, inflation interest rate expectations for 2023 and beyond are beginning to come down and beginning to roll over. Again, good for long duration assets, whether we're talking 10-year plus bonds or we're talking long-term growth assets such as healthcare, biotech, software, you name it. Lastly, China biotech and software stocks in particular are our favorite subgroups underneath the hood of the stock market right now. We do encourage being underweight commodities, underweight cyclical stocks. In particular, that would include like your auto stocks or steel stocks or material stocks. These areas that are very economically sensitive, we think will underperform here over the next few weeks to months. So that's what we got for you this week. If you have any questions, please feel free to reach out to your advisor. Feel free to reach out to us at our home office at 888-543-3776. Other than that, have a great weekend, everyone, and we'll talk again soon.